And what else is in the rest of the story? Let's take a look at, we're going to look at a couple of case studies here. This is the doctor and the civil servant. It seems like I'm picking on civil servants a little bit. Okay. So we're talking about Cheryl. Cheryl's a doctor. She finishes her residency at age 30. She has student debt of just under $200,000. She grosses $350,000 a year with 40% overhead. She's going to maximize her RSPs by taking a salary from her corporation each year, and that will let her leave $50,000 a year in the company, which will cover saving for retirement, but also pay for maternity benefits at some point in the future and to pay off her student debt. Bob, on the other hand, joins the civil service at age 25 with a BCom. His entry salary is only $40,000 a year, but he gets an MBA at age 30, funded, of course, by his employer, and he becomes an assistant deputy minister by the age of 50 because he's a bright guy. He ends up with a salary at age 60 of $200,000 a year and a pension of $133,000 a year indexed for life. So what else do you need to know about this picture? Well, for starters, Bob's pension is fully guaranteed. So let's set aside the value of the pension. At no point in his career does Bob ever have to worry about whether 2008 or the dot-com crash occurs or anything like that. He doesn't have to worry about whether his income from his investments will be lower because interest rates are 2%. His pension is fully guaranteed. There is no risk. The contributions, and this is staggering, but this is not an exaggeration, in order to fund a pension like that, you would need to put in 50% of your income from the day Bob started at 25 till he was 60 and earn a 4% real rate of return on that money to get to the value of that pension. If he only was able to put money into an RSP, he couldn't put 50% aside on a tax-free basis. It would be limited to 18. There's no tax on the extra income that goes into his pension, and there's no tax on the earnings it makes. And furthermore, the benefits of that pension never show up on his T4 slip. They don't show up as part of his income at all. So when we're measuring his income, and he says he makes $200,000 a year, it doesn't say he made $200,000 and he had $100,000 contributed to a pension for him. It just says he makes $200,000 a year. That's the measuring stick. Medical companies pay tax at roughly 13% in the lowest tax province in this country, and then they pay 50% on accumulating assets on the passive income. Cheryl's going to fund 100% of the savings for retirement and accepts those risks. And if she does really well and earns the same 4% real rate of return after fees and costs and inflation, she will accumulate $1.5 million by age 60. Now, if we look at the savings in the medical corporation at $50,000 a year after taxes and inflation, that's another $1.4 million. The bottom line is she will, in total, only have 90% of the value of Bob's pension, which is $3.3 million. She has to fund 100% of her sick pay, holiday pay, maternity leave, and health benefits. Now, when Bob retires, he lowers his tax liability by being able to split his income with his spouse, as we mentioned before. To add real insult to injury about the way the rules work, he can split income at 60 when he retires. If Cheryl retires at 60, she has to wait till she's 65 because her registered income comes from an RSP, not a pension.